A week feels a long time in markets at the moment, but it was just a week ago that the European leaders sat down for their 7th summit for 2011. This was to be the most important summit. But I think this week the assessment of that summit is that nothing really conclusive came out of that meeting. That this is a situation that will continue to rumble on through 2012, and we've generally seen sort of movements in European bond yields widening back out again, and in particular we've seen the euro currency beginning to weaken. That's the first chart I want to look at today. We did highlight this last week, just really reflecting on the trend that we were seeing in the euro. It's been a sort of a trade that's taken a while to play out this year. There have been many hedge funds and the like who have been betting against the euro this year, and I think it's been a case that the euro has held up better than most people have expected. However, what we have seen is a fairly marked deterioration this week, retesting that 130 level against the dollar at the moment. That was last seen very much at the beginning of this year, so we are now into a situation where we're at a 12-month low. The question mark is where does it go from here? We have seen lows, as we can see back here, in the middle of 2010 at around the 120 level, so a concerted break below 130 could be interesting. But it does beg the question, obviously a cheaper currency is really what many of the southern European states of Europe do require. They need to become competitive, and it is the high rate of the euro benefiting from those sort of powerhouses of Germany that has made it stifling for competition for these southern European countries to compete on a global scene. I dare say it needs to move a lot further than 130 or indeed 120 to bring these countries back into line. But it's an interesting move, and I think these changing currencies at the moment are going to become a dynamic for 2012. Indeed, I do want to look at one other currency, which is the Aussie dollar versus the Japanese yen, and this is a trade that is put on by many hedge funds to reflect when they want risk on or risk off. If you think of the Aussie dollar as a commodity currency, on the Aussie economy is very much built around the mining sector. Of course, when risk goes on, you buy commodities, you buy the mining stocks, and you indeed buy the Aussie dollar. When risk comes off, you take your money off the table there and you go back to the safer haven of the Japanese yen. So these are the sort of movements that we see, and these are currencies that are traded quite actively at the moment by hedge funds in trying to manage the risk. I think it is a common feature of 2011 that the correlation between asset classes of currencies, commodities and also equities has been so high that it just does become the case that when people have positive sentiments, and that tends to last for a few hours rather than a few days, these are the sort of trades that they do put on. Looking at the commodity sector as a whole, we have seen some movements this week that have brought the commodity space back down to a low, and this is absorbing what has generally been higher oil prices. We've seen some quite sharp movements lower in things such as copper. We saw a 3.5% movement on copper in one day of last week, and so this is a feature that we're seeing commodity prices coming lower. This may be reflective of the fact that the stance that's being taken in Europe at the moment is leading to lower calls for economic growth globally during the course of 2012. And also gold. I wanted to mention gold because gold has been a safe haven asset class for many, but as there is a general de-risking that is taking place across the globe, it looks like all asset classes are now being swept up into that. We've seen a very significant move down in gold, which has now broken the 200-day moving average at the moment, and the question is whether that bull market that has now been sort of very much persistent through the course of this year and previous years, is this coming to an end, or is this the pullback that you buy into? Too early to conclude. My suspicion is that there's still some de-risking to take place within financial markets, and therefore the returns that gold has achieved over that period of time, and the fact that much of gold is traded through financial futures, so there's a hell of an amount of leverage that is built into the gold price, that if we are seeing de-risking, then that could come under some further pressure in the short term before more fundamental buyers come through. I do want to finally conclude on the equity market with one of Killik's stocks for 2012, just purely to demonstrate through all of this noise of currencies and commodities and risk on and risk off, that the equity market does concentrate at times on businesses that do perform. Imagination Technologies, which is a £1 billion mid-cap player that is on, as I say, Killik's list for this year. This is now into virtually all-time high territory. It briefly touched higher than this in the dot-com boom of 2000, but this is a company that provides the graphic capabilities for most of the Apple products and indeed many of the electronic products that are sold around the world. And what they were confirming is that regardless of recessions, regardless of the cautious outlook for economies, electronic products do continue to sell, and they're selling because graphic capabilities are getting better and better. They're probably going to sell 350 million units around the world of consumer items that incorporate their design chips, and indeed where they think they'll be within 5 years is that over 1 billion products will be sold. So that's a share that has broken into new high territory, and as I say, reflective of the fact that regardless of what is going on in the world, businesses that perform are getting the appropriate ratings into the stock market.